Wednesday, October 30th, 2024, Monaco 64, home of alternative economics and contrarian views. So if you would have told me in the beginning of 2024 that gold would have been up 35% before the end of October and silver 43%, yes, I would have been a bit surprised. Yes, I've been a stacker for over 20 years, and I know gold has averaged about 10% a year this century in all the major currencies. Yes, 10% return. But in the last few months, things have been getting interesting, and we are breaking some key resistances, and we have broken, and I've spoken about that. So I'm not surprised anymore, of course. But what I want to talk about is what this could be signifying, this massive move in gold and silver. And we're also going to look at whether it's ever going to be safe again to liquidate some of your gold and lend money, i.e., let's say to the U.S. Treasury or Uncle Sam, because that was the right thing to have done back in the early 80s, and you would have done really well. And we're also going to look at why gold is such a resilient reserve, and this is referencing Tony Dayton. Very interesting piece here about, I think, what gold is telling us. And yeah, so let's start with whether it's ever going to be safe again to jump out of gold and back into treasuries. And I always remember Jim Sinclair, who was called Mr. Gold in the 1970s, early 1980 gold bull market. He said that when the 10-year yield went above 15%, he sold his gold and bought treasuries. And the 30-year as well went just above 15%. So, and gold, of course, had gone from $35 an ounce back in 71 to $850 in 1980. So you did really well. Gold really performed well versus the fiat dollar, and interest rates as well went up. So yeah, and that happened to be the bottom of the bear market in bonds and the top of the gold bull market. So it was the right thing to do. Can you imagine you had $1 million in gold and you sold that and you put your money in 30-year treasury bonds at 12%, let's say. I think that the top was 15, but I'm not sure whether Uncle Sam issued anything at that level. They probably did. But you'd be getting like $120,000 a year for 30 years. And that was probably the best, well, it was the best time ever to buy treasury bonds. But the only difference with nowadays is that Uncle Sam is up to here in that. Back then, I think the U.S. public debt to GDP was about 33%. Now it's 133. And apart from that, we've got all the unfunded liabilities that even President Trump is promising to honor no matter what. So we got, I think, 200 trillion there in unfunded liabilities. We got a public debt that's around 130% of GDP. So if we see gold continue to go higher, let's say into the thousands and thousands, and treasury yields continue to go higher like they have since 2021, will there be a time when we can do a Jim Sinclair and sell our gold or some of it and lend it to Uncle Sam? I'm going to leave that one for you to decide whether you think in the current political environment, whether you can trust not just who's in the White House, but who's in Congress and in the Senate. I think personally, yeah, I just don't see it happening. The only way I see it happening is if there's a complete collapse of the current system and something new comes up. But then these new debt will be completely different. So I don't think the current Treasury securities are safe. Yes, you might want to keep some in short-term bills, like a month or even a couple of weeks, or maybe 3 months at the most. I don't even think the short-term treasuries, like two treasury notes, not bills, but like the 2-year or even the medium-term 5 years are safe. So, what would it take for Uncle Sam to regain credibility? Because I think that's what's happening. And it's not just in the United States. It's going to happen here in the UK. And today, of course, is an important day because we got the budget in a few hours. I think it's going to be the same situation. What would it take for the world to gain faith and confidence in the current treasuries? Because this could all collapse. I just don't see a way out, even if Trump wins and he performs magically. It's really hard. It's a matter of maths. Yes, you can try to deregulate the economy, cut taxes, cut the size of government, cut the budget deficit by $2 trillion, like Elon Musk said to Howard Lutnick. And isn't it interesting that Howard Lutnick, who I worked for, when I came to work in London in 1992, I came to work for Cantor Fitzgerald in London. A friend of mine was there, and he poached me from my job in Switzerland, and Howard Lutnick was our boss. And he's been the head of Cantor Fitzgerald for many, many decades. And Cantor Fitzgerald is the biggest broker in U.S. Treasuries. Cantor Fitzgerald spread the sale of Treasuries around the world. So here's a guy who's going to be, well, if Trump wins, and I think that is very likely, he's going to be the co-chair of the transition team, and here's a guy who knows how to sell debt, but I'm not sure it's salvageable because, yeah, you cut the size of government, you cut taxes, you cut regulations. It should help the private economy, but is it too late? I'm afraid it could be too late, but who knows? I wouldn't want to risk my capital. I think, if we were talking about 1980, 81, then yes. But now things are so different. There's so much debt, and the cycles have turned, and I don't think anything can change the rise in interest rates, because we had a 40-year bull market in interest rates from 1981, or in bonds from 1981 to 2020. And what did that mean? Well, that meant that bond prices kept rising, yields kept dropping, and the debt kept growing because it's getting cheaper and cheaper to borrow. And the other thing is, well, the government has become such an important part of the economy because of all the deficit spending. If you cut that very quickly, you could drive the economy into a depression, and you could as well put the banks under pressure. And I think that's what gold is telling us. And what if the other person won the election? Well, nothing would be different. Yeah, I think so. I don't think, at least in my lifetime, the next 20, 25 years, I don't see us being able to do a Jim Sinclair with the current system. And I say that because if everything implodes, something new could come up. But then the people who are holding bonds right now, they're going to be in trouble because they're going to be almost wiped out. They'll get something in the next system. And that's how it works. And that's why I also think the 60-40 portfolio, yes, it has been a good place to be. But I don't know. Well, you probably know that there's when you buy, I don't smoke, but if you buy cigarettes, it warns you that it could kill you. And I think the 60-40 portfolio now should come with a warning. This portfolio could kill your finances. So what's the solution to the 60-40? Well, you need to have some gold and silver physical. Doesn't even have to be 100% of what you own, but I would say at least 10% or even more. And this, of course, is not financial advice. So let's go to what I think why gold is so resilient. And the other thing is, well, you might be watching me for the first time and you might be saying, what are you talking about? The stock market is near all-time highs. Treasury yields are pretty steady. Well, yes, that's right, because the mainstream media doesn't even look at gold, doesn't understand gold. Gold is basically the anchor for everything, even though we don't have gold officially as part of the monetary system. It will come back. It always does. And that's why I make these videos, to warn people about it. So gold, the resilient reserve, and I have to thank Simon Mihailovich. He's on X if you want to follow him, as you can see there. And he says, an excerpt from Gold, the Resilient Reserve by Tony Deedon. What makes gold compelling are the risks we do not take by owning it. No forecasting or guesswork is required. The risks we do not take owning gold could fill volumes. With gold, there is no duration risk. Yeah, that's owning long-term treasuries or lending money for 2, 5, 10, 30 years. Credit risk or liquidity risk. Yeah, there is no liquidity risk. Gold, you can take my little gold bar here anywhere in the world, and someone will exchange it for the local currency. So it's liquid anywhere, anytime, yeah, in any culture. The metal is not moved by financial instability, nor threatened by national insolvency or chaos in foreign exchange markets. There are no margin calls and no refinancing risks. Well, there are margin calls if you trade paper gold on COMEX or the LBMA. Of course, I don't recommend that. There is no risk of technological obsolescence, depletion, depreciation, or decay, nor does it require cheap energy, cheap credit, or cheap trade to remain viable. It does not care about your national energy policy or who you buy your gas from or how many pipelines are running. You do not have to keep the lights on or even keep it warm. There are no financial accounts to pour over, no balance sheet to blow up, no cash flows to dwindle, no stale inventory, and no margin pressures in difficult times. There are no key manpower or supplier risks, no competitive risks, no management to squander its future. It does not depend on the character, skill, or enthusiasm of anyone. It does not require the faith or goodwill of others. It does not require you trust anyone at all, except that you must hold it in a very safe place. Bottom line, gold is the only universally liquid financial asset that is no one's promise, which is why demand for it rises whenever trust in promises declines. So, very significant, and I think that's why we're seeing the demand for it rise, especially from non-Western central banks, and it's going to start. I think it's starting now with the public in the West. So there you go. So there, the choice of owning gold and a bond is this. You can own a German government international loan for 5.5%, which was issued in 1930. It was a 35-year loan, or you can own gold. So what happened to this loan? Well, it was organized by JP Morgan in New York, and the money was raised for the German government. And yes, the last time they paid a coupon was in May of 1945, as you can see here, because the coupon for June of 1945 is still on this bond. So what happened? Well, we know what happened after 1930 in Germany, and by 1945, Germany was defeated. Yes, you lost your $1,000. There you go. Yes, you did get 5.5% a year from 1930 to 1945, though, which is interesting. Another interesting topic, different topic, though, that Germany kept helping finance Germany throughout World War II. Isn't that interesting, right? I know what I'd rather have. So it's up to you to decide, of course. And again, this is not financial advice. It's just my opinion. So let's quickly look at where the markets are this morning. It's 8:30 a.m. London time. Spot gold has made a new all-time high overnight at 27.90. Right now we're at 27.84, so we're up about $9. The low's been 70, and the high 90, of course. And I think, it's weird that we're not seeing any big corrections here. It just goes to show, I think, that there's a lot of demand, physical demand, and when we do see some corrections, I think a lot of the paper shorts, the bullion banks, are using that to desperately cover their short positions. How do you cover short positions in derivatives? Well, you go long. You buy the contract, so you neutralize it, and that makes the price go up. Silver, on the other hand, is still fighting here. Yes, silver is outperforming gold year to date in terms of performance, but right now we're down 23 cents at 34.21. I guess 35 is the big target. High overnight has been 54 and the low 09. The big thing to watch for us in the UK, of course, will be the budget. It's in about 4 hours from now. And I saw that the 10-year yield yesterday went above 430. Right now it's at 430. And we'll see how the market reacts to the labor budget. U.S. Treasury yields, while the 10-year yield has come off a little bit, about 3.5 basis points, it's still around 4.25% though. Don't forget, we were at 3.60 when the Fed cut rates on September 18th. So with that, I'm going to wish you all a very good day. Take care. Bye.